Hello and welcome to the Weekend Investing Daily Byte of 23rd of September. Another good day for the Indian markets. And a lot of people are just watching the markets in total disbelief, how the markets are climbing up the walls of worry. And significant cash is on the sides, waiting for a dip, waiting for a correction. Many mutual funds, many institutional investors, many HNI investors have gradually gone to cash or to some good portion of cash. In fact, one of the uh, I would say popular mutual fund has gone to max cash or nearly 20%. And who to blame? Warren Buffett is sitting on a lot of cash. So it seems the world is flush with funds, and on top of that, the rate cycle has begun downwards. So there is going to be no uh, scarcity of liquidity as such, because the interest rates as they come down will infuse more liquidity. Credit will be easily available, and just waiting for a market crack to deploy funds may or may not be such a great strategy. Anyhow, so let's get into the video today. How the markets will play out is anybody's guess, but should we wait for a small cap correction is the topic that we're going to discuss today towards the second half of the video. Do keep watching to the end of the video to have that perspective. Also, please subscribe to the channel. It motivates my team to keep doing this on a daily basis. Where is the market headed? Frankly, while nobody really can say, but the market trend currently is certainly very, very positive. We've suddenly moved within the last 2 weeks from near 25,000, rather 24,700 to 25,900. Another 0.57% gain today. So in this last 2-3 sessions itself, we've gained almost some close to 500, 600 points. And this is complete disbelief by a lot of folks who are waiting for a correction. Nifty Junior, dramatic gain last two sessions, 1.6% up today, catching up with Nifty. It was sluggish for the last 4, 5, 6 sessions, but today a clear breakout, and the market was up. Nifty 150 index, Nifty mid cap 150 index also up a nice 0.75%, again closing at a new all-time high. And the small cap index also closing at a new all-time high at 0.86%. So across the board, across all subsections of the market, you saw all-time highs. That is not a sign of a weak market. Yes, sometimes when market is at an all-time high, it may be making a top to come down, but that probability or percentage is very, very low. As the market continues to go up, each point it is making an all-time high. So all-time high should not be something that one is afraid of. Yes, sometimes it will not work, but most of the time it will work. So that is the sort of thesis that you have to, when you cross the road, most of the time you will be safe, right? So that's why you cross the road. If you start thinking that, oh, this time when I'm crossing the road, the car will come and hit me, and hence I should not cross the road, that is stupidity. So bank index, amazing run from 50,500 to 54,105 in less than 2 weeks now. The bank Nifty has actually lifted the spirits of the market despite it being sluggish till the Fed 0.5% cut outcome. I think it is sort of late realization in the market that yes, Indian rates will also come down, bank bond books will improve, bank credit offtake will improve, and hence banks have been left behind in the relay race versus others. So banks should go up, and hence banking has suddenly gone up. In terms of advance declines on the top 500 stocks, clearly in favor of advances, 331 to 166, so no complaints there. And massive 14,000 crore uh, FII buying on 20th of September, and DII was selling. There was a MSCI rejig, and that also caused a significant amount of money to come in. But nevertheless, I mean, money coming in is money coming in, whatever may be the color of it. DII is selling them 4,400 crores. So DIIs have been sort of either on a back foot or playing defensive, but FIIs are now playing very aggressive. Today's heat map, mostly green. You had SBI leading the PSU banks today, 1.4%. Reliance up 0.7%. ONGC Coal India also up. Bharti has been continuously going up. Bajaj Auto Mahindra also continuously going up. Levers up, NTPC up, Nestle up. Most of the stocks up except ICICI Bank, which was up on the previous session. So nothing really lost on that either. In terms of the Nifty Next 50, you had a lot of green here as well. And today, the public sector enterprise stocks also were running. IOC, BEL, HAL, PFC, all these stocks were running. GAIL, and you also had Bank of Baroda, Canara Bank, PNB, the PSU banks also running. Zomato was running. Trent was running. ABB, Havells, Motherson, Bosch, Siemens, all doing very, very well. LIC also up along with DLF. In terms of sectoral trends, PSU banks made a huge comeback today. So there is a sort of a relay race that is happening for a few sessions. If one sector is down, it becomes the baton is handed over to that sector for the next run, and that's what happened with PSU banks, which were very, very sluggish till yesterday. Uh, and just in one session, 3.4% up on that. Real estate is now 10% on a 1 month basis and leading the rally. However, on a 3 month basis, real estate is one of the third lowest. But suddenly now the focus has come back to real estate. Public sector enterprise stocks are also recovering 1.8% today. Auto stocks, consumption stocks also rallying on lower interest rate speculation. And if we see the last 3 months, then consumption stocks, FMCG, pharma, and IT, all defensive sectors were doing well. But if you see on a 1 month basis, or maybe on a weekly basis, you are seeing real estate, consumption stocks, bank nifty, private banking here, autos also doing well. So there is a sort of a shift that is happening from defensives to risk on trades. And if we see over the last 12 months, almost all sectors have done well, with real estate, of course, in three digits, public sector enterprise in it at 86%, energy at 60%, doing really, really well. So even if you had missed some of the sectors, a lot of the sectors have really done very well over the last 1 year. PSU Bank has taken this support that we were talking about just a couple of sessions back, and all these banks, Bank of Maharashtra, Punjab Sind Bank, Indian Bank, Central Bank, UCO Bank, IOB, all of them doing more than 4% for the session. Stock spotlight is on SBFC Finance, up nearly 20%. It had been consolidating since almost 9 or 10 months, and in one shot, it has just gone and hit a new all-time high. Should we wait for a small cap correction is the discussion for the day. If we see from previous April, so about in last 18 months, small caps and mid caps have taken a big lead over larger caps. So Sensex is up 47% in the same time period. Small cap and mid caps are up nearly 110 to 120%. And the BSC 500 overall is up about 70%. So you can see that these two segments, mid and small, have really taken a huge lead. But in the last 2 weeks, you can say uh, large caps are beginning to take lead. Large cap are up nearly 5%, whereas mid cap and small cap are up 3% and 4%. So some deviation is happening, although not as much in terms of how the divergence is taking place. There is also some RSI divergence on the small cap index. So small cap index is not looking as strong as the large cap index is right now. Mid and small caps have also underperformed the broader market. So you can see here that mid cap index, while year to date is very high, but if we see the last 1 month, then versus the Sensex, BSC mid cap is down, versus the Sensex, BSC small cap is also down. And in the last 3 months also, the mid and small cap have performed somewhat equal or less than the larger caps here. So there is some repositioning in the market that is happening. Share of stocks that have fallen over 20% from the 52 weeks high are also quite high in mid and small cap, 20% and 37% in small caps especially, and the top 500 has only 24%. So again, small caps are beginning to fall more. So the natural question will be, should we exit small caps? A lot of folks are talking about soaring valuations in small cap companies, and sitting on cash waiting for good opportunities and so on and so forth. But if we see the index price earnings ratio, then pre-COVID, I mean, the peak was at 47, and median PE has been at nearly 30 since the last 4 5 years, and we are currently now at 36 or so. So in terms of valuation, I mean, we've been at much higher valuation 4 years back, 3 years back, and we are now inching towards that again, but still quite far away from it. So you never know how long the irrationality, if there is any, can remain. Fund houses, as I mentioned, are sitting on cash, and the cash is sort of stable or going up in terms of small cap funds in the last few months, I would say. 6 to 8% is somewhat cash on hand. If we see the small cap to Sensex ratio, this also has climbed to quite a high point at 0.68. It has not been as high as this in the last 20 years. So small caps have outperformed the large caps in a big way this time, and maybe this ratio will top out and come down at some point. It does not mean that small caps may stop rising. It just means that large caps may rise more. That is the sort of uh, one thesis one can draw from it, but what you can really never say. So should you wait for a correction also? I mean, should you get out of small caps and get in once the correction is there, or allow a strategy to to do its thing? Because what can happen is that while you may all the thesis about the small cap being overvalued or overstretched may be right, but it may so happen that the irrationality may continue for another 6 months, and then a correction may happen, and or it may happen tomorrow. So this is something that we don't know. And this is also when the COVID rally had started, people sold off here, and then later they regretted the decision to sell off in this period, because it just continued to move up. So rather than trying to time the market, rather than trying to have a very ad hoc way of approaching the market, just why not just have rules and frameworks to your rescue? So have strategies which have automatic exit plans, so in case small caps do start to fall off, you will automatically rotate into either cash or in defensive stocks if you get into momentum strategies. And of course, your exposure to small caps can also, the allocation can change. So if you were largely allocated to small caps, maybe you can reallocate some of that money towards large caps, or distribute that money across different uh, types of the segments in the market. So that's the sort of a broad discussion we can have on small cap concentration, on small cap exposure. Do let us know what is your view on this. I'd love to read your comments, and I'll see you in the next one. Thanks. Bye.